Hey guys, welcome back to the channel. In this video, I share what I think are the two best BetaShares ETFs that have the strongest growth potential over the next 10 plus years. I explain why I think they'll thrive over time and how I'd go about buying shares today given all the turmoil in the market recently. If you enjoyed the video, please consider hitting that like button and subscribing to the channel. So the first ETF we're going to look at today is the BetaShares Asian Technology Tigers ETF with the ticker symbol ASIA. This ETF tracks the 50 largest tech companies in Asia excluding Japan, and has management fees of 0.67%. This is a little expensive for a passive ETF when you compare it to some of the cheap Vanguard funds, but I really like the Asia ETF and there's a few reasons why I think it has huge potential over the next 10 or so years. The first reason is the quality of the holdings in the portfolio. Like I mentioned before, the ETF's holdings are based in Asia, with the allocation being 44% in China, 24% in Taiwan, 19% in South Korea, and 7% in India. And if we look at the actual portfolio, a lot of their holdings are some of the biggest and best companies globally, not just in Asia. We all know Samsung, of course, but then you have Taiwan Semiconductors, which is one of the most important businesses in the world today. TSMC, as it's called, is the world's largest manufacturer of semiconductor chips, which are the chips that are used in our phones, laptops, cars, and just about everything else we use in our day-to-day life. They're not that well known, but they're one of the largest companies worldwide by market cap, at over 500 billion. And given how critical their products are to our society, I can almost guarantee they'll still be around in 10 plus years. Another quality business with a bright future is Tencent. After Meta, Tencent have the most users of any business in the world, with over 2.4 billion monthly active users across their social media apps. They're an absolute powerhouse company in China, and I definitely think they'll still be around in 10 years and be much more valuable than they are today. Then there's Alibaba, which is another Chinese powerhouse. Alibaba have the highest gross merchandise volume out of any e-commerce business in the world, including Amazon. Then you have a few other decent businesses like JD, Meituan, NetEase, and Infosys. So I really like the top holdings, and I think some of the quality companies in the top 10 will drive returns for a long time. The next reason I think this ETF performs really well over the next 10 years is the current price. So for those who don't know, China are going through quite a big market crash at the moment, and some of China's largest businesses have been getting absolutely hammered in the market. Alibaba's down more than 70%, Tencent's down nearly 60%, Taiwan Semiconductors is down 20%, and JD is down 50%. It's been pretty crazy, and this of course led to the Asia ETF crashing by about 50% as well. I think a lot of the fears that caused the crash are a little overblown, like the fears of delisting or the Chinese government stealing your money. So for those enterprising few who don't mind volatility and have a long-term time horizon, I think now would be a pretty good time to start building a position. Given the current environment, it'll probably crash more, and I have no idea how long it'll stay down. So I think dollar cost averaging is the way to go here. I'd probably buy small bits at a time over the next year or so. And that way, if the Chinese market keeps crashing and it drags the ETF down with it, the price keeps getting better as it goes lower. If you're nervous about Chinese companies, I highly recommend looking into some of the companies in that portfolio and reading about their future projections. Overall, I think it's a solid portfolio for investors who don't mind a bit of volatility and have a long-term time horizon. Alright, next up we have an old favourite that you're probably sick of hearing me talk about, and that is the NASDAQ 100 ETF with the ticker symbol NDQ. I think I might be a bit biased towards this ETF, because in my own portfolio I own an extremely concentrated portfolio of high quality businesses. And out of all the ETFs I've ever looked at, this ETF has the most concentrated portfolio of high quality compounders that I've ever seen. If we look at the top 10, most of these businesses are wonderful high quality businesses with great future prospects. And the top 10 take up over 52% of the entire portfolio, which means the long-term returns are probably going to be decided by the performance of these 10 businesses. If we look at any of these businesses, do you honestly see any of them being dislodged or decrowned over the next 10 to 15 years? Yeah, me neither. I mean, you have some of the strongest businesses in the world today, like Apple, Google, and Microsoft. And you also have some businesses with really long runways ahead, like Amazon, Tesla, and Meta. So the odds of a permanent loss of capital is really low. Right now, with all the turmoil happening around the world, and all the fear and uncertainty surrounding the market, NDQ has dropped 20% from its all-time highs, which could also be a pretty good buying opportunity for someone looking to build a position. Again, with the next few months being so up in the air, I think dollar cost averaging might be a good strategy to build a position over time. If the market crashes more, great, you can buy some more. And if it goes back up, you can just buy smaller amounts and set aside some cash for a bigger correction. I think the biggest reason I like this ETF, and this is a personal preference, is it doesn't hold companies I don't want in my portfolio. Part of my issue with buying broad market ETFs like the S&P 500 is they own companies I really don't like, such as big tobacco, oil, big pharma companies, and other types of companies that behave in ways I find distasteful. And if possible, I'd rather not support them at all, even if it is passively. With the two ETFs I mentioned, they both have a pretty narrow focus on certain types of businesses that all kind of fall under the umbrella of tech companies, which is right up my alley. Like the Asia ETF, the road ahead for NDQ might be bumpy, but as long as the destination is favourable, who cares? As Nick Sleep says, travelling comfortably dominates people's thinking, when they should be thinking about destinations. If compounding your capital at the highest potential rate without taking massive risks is your destination, then elementary mathematics shows that owning quality businesses, objectively, is the most important driver of long-term returns. I'll put an article in the description if you're interested in reading why and the maths behind it. So overall, if I was passive investing, these two ETFs are most likely the ETFs I would own. And because I can't predict the future over the next year or two, I'd probably dollar cost average into both of them. And I'd try to buy as much as I can when the market's down. Now, this strategy might be considered aggressive or risky, but at the end of the day, everyone is different. And to me, it makes the most sense to invest in the best businesses with bright futures, and less of the crappy businesses with no futures. And I don't want to invest in companies that I really hate, and I'd be ashamed to tell people that I'm invested in. Of course, this depends on what type of investor you are. If you need any help or you have any questions about anything I said, please hit me up in the comments below. I really enjoy talking to you guys in the comments, and I'll try to help as best I can. If you've enjoyed the video so far and you want to support the channel, I'd really appreciate it if you hit that like button. And if you want to see more videos like this one or join our little community, then hit that subscribe button. And if you're still interested, I'll put another video up in the corner that I think you'll like. If you've watched the video all the way to the end, thank you so much for watching. If you're new to investing and you want to learn how I invest using the Buffett Munger framework, or if you just want to download and use my intrinsic value spreadsheets, then check out the free course on the channel. I go into every aspect of value investing in detail. And as always, this video is not financial advice. Please always do your own research before making any investment decisions. So that's it for today. Thank you so much for watching, and I'll see you guys in the next one.